What if I told you America's $38 trillion debt is already shrinking your paycheck right now without a single news alert? Not someday, today, quietly, automatically. And almost nobody is talking about the real danger hiding beneath that number. Look at your last bank statement. That balance feels solid, but it rests on a promise most of us never question, that tomorrow, that money will still buy what it buys today. That promise depends on one fragile thing: global confidence in American debt. And that confidence is shifting. Not collapsing, not crashing, but quietly rearranging itself beneath your financial reality. Here's what you need to know immediately. The danger isn't the size of $38 trillion. It's who holds that debt and why they're changing their minds. Right now, the US spends more on interest payments alone than on national defense. Over $1 trillion a year, gone before a single road gets paved, just to keep promises made years ago. And this number grows automatically every time rates shift, every time new debt rolls over. No votes, no debates, just math working in the background of your life. But here's the twist most experts miss. Foreign governments, the traditional buyers of American debt, are quietly stepping back. Japan, China, oil-rich nations. For decades, they treated US Treasury bonds as the world's safest asset. That demand kept borrowing costs low. It gave Washington extraordinary flexibility. But that era is ending. Not with headlines, with silence, like sand slipping through fingers. And in its place, something unprecedented. The Federal Reserve itself has become the largest buyer, creating money electronically to purchase government debt directly. The government, in effect, is borrowing from itself. This changes everything, because when your central bank becomes your primary lender, the old constraints vanish. The marketplace no longer disciplines spending, the printing press does. And that creates a question we can no longer avoid. When debt reaches this scale and this structure, does it still function as debt? Or has it become America's invisible backbone? The quiet foundation shaping every financial decision you'll make for the next decade. Most people imagine debt as a simple ledger. Money borrowed, money owed. But that picture misses the real story. The story isn't about the number. It's about the buyers. Who holds this debt determines everything. How stable your retirement stays, how flexible America remains, and when the quiet math beneath your finances might suddenly shift. 15 years ago, nearly half of US debt was held overseas. Foreign governments bought treasuries not for high returns, they accepted low yields, but because dollars anchored the global economy. That external demand acted as a brake on American spending. If confidence wavered, buyers could walk away, rates would rise, discipline would return. But that brake is fading. Today, foreign ownership has dropped to under 30%. Japan and China have been quietly reducing positions for years. Not dumping, not panicking, just slowing their purchases as their own economies evolve. Meanwhile, the Federal Reserve has stepped in, buying trillions in government bonds directly. This worked brilliantly during crises. It prevented collapse in 2008. It enabled massive stimulus during the pandemic. But it created a dependency. Fiscal decisions now rely on the Fed's support. Without it, current borrowing levels would trigger much higher interest rates almost immediately. The math simply wouldn't work. This shift matters more than most realize. When foreign governments hold your debt, they act as external disciplinarians. They can choose to buy less or sell what they hold. Their decisions reflect confidence in your economy's future. But when your own central bank becomes the primary buyer, that external discipline vanishes. The constraint moves from the marketplace to the printing press, and a new question emerges. If the Fed can always create money to buy debt, why would the government ever need to balance its budget again? The answer lies in what happens next. The US government needs to borrow roughly $2 trillion every single year just to cover its bills. That's the new normal. For decades, global demand met that need effortlessly. But demand isn't infinite, and the composition of buyers is shifting toward pension funds, algorithmic traders, and the Fed itself. This isn't conspiracy, it's structural transition. The debt hasn't just grown larger, its ownership has transformed. And with that transformation comes a subtle but profound change. America is losing the flexibility to respond when the next crisis hits. Debt at this scale doesn't happen by accident. It follows a pattern, a rhythm that has repeated across centuries and civilizations. The pattern isn't about morality or political failure. It's structural. It emerges whenever a dominant power reaches the peak of its influence and begins financing that dominance not through current production, but through future promises. Think of it this way. When a nation controls the global financial system, it gains a unique privilege, the ability to borrow in its own currency on terms no other country enjoys. The United States can issue debt denominated in dollars, currency it alone controls, and the world accepts those IOUs as safe assets. No other nation has this luxury. Only the issuer of the world's reserve currency operates under these conditions, and this privilege creates a subtle trap. The trap works like this. Easy access to borrowing makes difficult choices optional. Why raise taxes when you can issue bonds? Why cut popular programs when markets will absorb the debt? Why confront structural inefficiencies when tomorrow's lenders will cover today's gaps? Each deferral feels rational in the moment. Each decision makes political sense. But cumulatively, they create a dependency, a feedback loop where maintaining the system requires ever larger borrowing, which in turn requires ever greater confidence from buyers. The system doesn't break under strain. It breaks when confidence shifts. This pattern has appeared before, not identically, history never repeats exactly, but structurally. The Dutch Republic in the 17th century dominated global finance through the Bank of Amsterdam and the guilder. It borrowed heavily to maintain its naval power and commercial networks. For decades, the system held. Then, confidence eroded, not from a single event, but from the slow realization that debt service was consuming resources needed for adaptation. Let's look at Venice in the 15th century. At its height, Venice controlled Mediterranean trade routes and operated Europe's most sophisticated financial system. Its debt was considered rock solid. Merchants and nobles bought Venetian bonds as safe stores of value. For generations, this worked. Venice borrowed to fund its navy, its diplomacy, its commercial infrastructure. But slowly, two forces converged. First, Portugal discovered sea routes around Africa, bypassing Venice's choke points. Second, Venice's debt service consumed an increasing share of state revenue. By the early 1500s, over half of Venice's annual income went to paying interest. Not to innovation, not to adaptation, to servicing past obligations. The Republic didn't collapse overnight, it ossified. It lost flexibility to respond to changing trade patterns. Its financial strength became its strategic weakness, a rigid structure unable to bend as the world shifted beneath it. Move forward to Britain after World War I. Britain stood victorious, but exhausted. Its national debt had ballooned to over 130% of GDP. Much of that debt was held domestically, by British citizens, banks, and institutions. This created an illusion of stability. But domestically held debt carries its own constraints. It ties up capital that might otherwise fund new industries. Britain chose austerity in the 1920s to protect the pound's value and reassure bondholders. The result? Stunted industrial recovery, lost competitiveness. While America embraced electrification and mass production, Britain remained anchored to past obligations. The debt didn't cause decline. It narrowed the path of possible responses until decline became the default outcome. Notice the pattern across these cases. Collapse rarely comes from debt alone. It comes from debt combined with rigidity. When a system loses the ability to adjust, because obligations consume resources, because vested interests block reform, because confidence shifts subtly but irreversibly, the structure becomes vulnerable not to one shock, but to the cumulative effect of many small changes. The Dutch, the Venetians, the British, they all saw their dominance fade not with a crash, but with a slow constriction of options. The debt remained payable, but the freedom to respond to a changing world quietly disappeared. Today, America's debt operates on two parallel tracks. One is visible, the other is hidden. The visible track is the political theater we see daily: debt ceiling standoffs, congressional debates, headlines about trillion-dollar deficits. This theater matters symbolically, but it masks a deeper reality. The decisions that truly shape debt sustainability happen not in Congress, but in global markets and central bank offices. When Japan's Ministry of Finance quietly adjusts its treasury holdings, when algorithmic trading systems rebalance portfolios across milliseconds, these actions collectively determine whether America can continue borrowing $2 trillion annually without disruption. Congress debates, markets decide. The hidden track is more consequential. It's the growing interdependence between what the government spends and what the Federal Reserve enables. For most of the post-war era, these domains remained separate. Congress spent, the Treasury borrowed. The Federal Reserve set interest rates independently. That separation has eroded. Since 2008, the Fed has absorbed trillions in government debt directly, not as policy, as necessity. When private demand proved insufficient during crises, the central bank became the buyer of last resort. This created a new reality. Fiscal decisions now depend on monetary accommodation. Without the Fed's balance sheet expansion, current deficit levels would trigger much higher interest rates, making debt service unaffordable almost immediately. This interdependence creates a quiet dilemma. The government needs low rates to keep debt service manageable, but low rates require the Fed to maintain extraordinary measures that distort markets and encourage risk-taking elsewhere in the economy. It's a feedback loop with no clean exit. Raise rates to normalize policy and debt service explodes. Keep rates suppressed and financial stability risks accumulate in housing markets, corporate debt, and asset bubbles. There is no painless path forward, only trade-offs between different kinds of instability. Meanwhile, a subtle shift is underway in who holds the debt. Foreign ownership has declined from nearly 50% of publicly held debt in 2015 to under 30% today. Domestic holders, pension funds, mutual funds, the Fed itself, now dominate. This feels safer, Americans holding American debt. But it carries its own risks. Domestic holders respond to market signals, not geopolitical strategy. When volatility spikes, they rebalance portfolios rapidly. Algorithmic traders amplify these moves. The result is a debt market potentially more stable in calm times, but more fragile during stress. Less anchored by long-term strategic holders, more subject to short-term flows. Here's what this actually means for you. When the US Treasury needs to borrow, it holds auctions. Banks bid on new bond issuances and resell them to end buyers, foreign central banks, pension funds, insurance companies, or the Federal Reserve itself. The critical factor isn't whether buyers exist today, it's whether they'll exist tomorrow at prices that keep interest rates low enough for the system to remain stable. The Treasury market functions as the world's financial backbone. Banks pledge treasuries to secure short-term loans in a massive daily ecosystem that keeps finance flowing globally. If treasury prices become volatile, that backbone seizes up. We saw this briefly in September 2019, when a technical glitch triggered a liquidity crunch requiring emergency Fed intervention. The system recovered quickly, but it revealed a vulnerability. The entire financial architecture rests on treasuries behaving predictably. When they don't, everything wobbles. Now layer in the Fed's role. The central bank creates bank reserves electronically and uses them to purchase assets, including treasuries. During the pandemic, the Fed's holdings of government debt tripled. This wasn't charity, it was necessity. Without those purchases, the massive fiscal response would have triggered soaring interest rates. The Fed absorbed supply to keep borrowing costs low. But this creates a mechanical problem. The Fed earns interest on those bonds. It remits most profits back to the Treasury. In effect, the government pays interest to itself. This looks like a free lunch. It isn't. When the Fed eventually sells those bonds or lets them mature without reinvestment, it removes liquidity from the system. That pushes rates higher. The Treasury then faces a double bind, rolling over maturing debt at higher rates while losing the Fed as a reliable buyer. The math tightens quickly. A 1 percentage point increase in average borrowing costs adds roughly $200 billion annually to debt service. That's not hypothetical, it's arithmetic. Foreign holders operate differently. China and Japan don't buy treasuries for yield. They buy them to manage their own economies, to prevent their currencies from appreciating too fast against the dollar, which would hurt exports. Their demand isn't infinite. It's calibrated to their own needs. As their economies evolve, China rebalancing toward domestic consumption, Japan grappling with demographic decline, their need for massive treasury holdings diminishes. They aren't dumping bonds. They're growing slower than America's borrowing needs. The gap must be filled elsewhere. The real mechanism at work isn't conspiracy or malice. It's arithmetic meeting psychology. As long as buyers believe tomorrow's buyers will pay similar prices, the system holds. But belief has a tipping point, not a cliff, a slope. Small shifts in expectations compound. A pension fund manager slightly underweighting treasuries, a central bank diversifying into euros, an algorithm detecting reduced liquidity and adjusting models. None of these actions alone matters. Together, they change the market's character, from deep and resilient to thinner and more reactive. The structure doesn't break, it transforms. And transformation changes what's possible within it. Where does this lead? Not to collapse, not to hyperinflation. Those outcomes require specific conditions America doesn't face. Instead, the logical trajectory points toward constraint, gradual, structural constraint that reshapes possibilities without triggering crisis. Imagine a spectrum of outcomes. At one end, seamless normalization. Growth accelerates, tax revenues surge, debt stabilizes as a share of GDP. The Fed gradually shrinks its balance sheet without disrupting markets. This requires sustained 3% plus growth alongside fiscal discipline, historically rare outside post-war booms or technological revolutions. Possible? Yes. Probable, given current demographics and productivity trends? Unlikely. At the other end, disorderly adjustment. Confidence erodes rapidly. Buyers demand much higher yields. The Fed faces an impossible choice: let rates spike and trigger recession, or monetize debt openly and risk inflation. This scenario requires a catalyst, a geopolitical rupture, a loss of faith in institutions, or a technical market failure. America's advantages, reserve currency status, deep markets, rule of law, make this outcome improbable absent major external shock. The middle path, the probable trajectory, is slower and less dramatic. Debt continues growing faster than the economy. Debt service consumes an ever larger share of federal revenue. By 2035, interest payments could surpass defense spending entirely. This doesn't trigger crisis, it triggers quiet triage. Programs get squeezed not through dramatic cuts, but through failure to keep pace with inflation. Infrastructure maintenance deferred, research funding stagnant, adaptation to climate change underfunded, not because leaders ignore the problems, but because the math leaves no room. The constraint isn't political will, it's arithmetic. Meanwhile, the Fed remains trapped between conflicting mandates. Raising rates enough to meaningfully reduce debt growth would trigger recession. Keeping rates low preserves stability, but encourages financial excesses elsewhere: asset bubbles, corporate leverage, housing unaffordability. The central bank becomes less an independent actor and more a stabilizer of an increasingly rigid system. Its tools lose potency not through failure, but through overuse. Geopolitically, the trajectory points toward fragmentation. As confidence in dollar hegemony slowly erodes, not collapsing but diluting, alternative systems emerge at the margins. Oil trades settled partially in yuan, regional trade blocs using local currencies, digital payment systems bypassing Western rails. None replace the dollar overnight, but cumulatively, they create optionality. And optionality reduces the premium the world pays for dollar assets. That premium, what economists call an exorbitant privilege, has allowed America to borrow cheaply for decades. As it narrows, borrowing costs rise incrementally, not catastrophically, just enough to tighten the screws further. The defining feature of this trajectory isn't crisis, it's the slow disappearance of slack, the buffer that allows societies to absorb shocks, experiment with solutions, and adapt without immediate penalty. Debt doesn't eliminate that slack overnight. It consumes it molecule by molecule until one day the system finds itself rigid precisely when flexibility is needed most. What does this mean for you? Not your portfolio, not your next financial decision. Something deeper, your understanding of possibility. For decades, Americans grew up assuming the future would contain more opportunity, more mobility, more room for error. That assumption wasn't accidental. It reflected a system with slack, resources available to absorb mistakes, fund second chances, invest in long shots. Debt at sustainable levels provides that slack. Debt at current trajectories consumes it. This isn't about individual responsibility. It's about context. Your career choices, your community's resilience, your family's stability, they all exist within a system whose flexibility is quietly changing. When government spending shifts from investment to obligation, from building to maintaining, the ecosystem around you transforms. Not visibly, not overnight, but in the narrowing of options available to institutions meant to support you, schools with fewer resources to innovate, infrastructure less resilient to extreme weather, safety nets stretched thinner not by ideology, but by arithmetic. Awareness changes perspective, not to induce fear, to restore agency. Understanding that macro constraints exist allows you to distinguish between personal failure and systemic limitation. That job that never materialized, it might reflect not your inadequacy, but a system allocating capital toward debt service rather than growth. That community struggling to adapt to climate change, it might reflect not poor leadership alone, but a fiscal structure with less room for investment. This isn't excuse-making, it's accurate diagnosis. And accurate diagnosis precedes effective navigation. The most valuable position in a constrained system isn't prediction, it's adaptability. Systems with less slack punish rigidity. They reward those who can pivot, who maintain optionality, who build resilience at personal and community levels precisely because institutional buffers are thinning. This isn't about hoarding gold or building bunkers. It's about cultivating skills that transfer across contexts, relationships that provide mutual support, and awareness of when systems are shifting beneath the surface. Most importantly, recognize that debt's true cost isn't the interest payment. It's the opportunity not taken, the research not funded, the infrastructure not built, the adaptation delayed. These absences don't appear on balance sheets. They appear years later as reduced resilience when shocks arrive. Seeing this changes how you evaluate promises, political, financial, personal. It shifts focus from short-term gains to long-term flexibility. We began with a question. When debt reaches this scale, does it remain debt, or does it transform into something else? The answer is neither. It becomes infrastructure. Not physical infrastructure like roads or bridges, cognitive infrastructure. The invisible framework shaping what a society believes is possible. For 70 years, America's debt structure enabled expansion. It funded moonshots and interstate highways and research universities. It provided slack. Today, that same structure is transitioning toward constraint, not collapse, not crisis. Constraint. The quiet narrowing of options as obligations consume resources that might otherwise fund adaptation. This isn't moral failure, it's structural evolution. Every dominant power in history has faced this transition, not because leaders became less wise, but because success creates conditions where borrowing feels rational until the cumulative weight of rational choices limits future flexibility. The pattern repeats not from ignorance, but from the logic of privileged systems. America's advantage remains real, its economy dynamic, its innovation capacity unmatched, its institutions resilient. These strengths won't vanish, but they will operate within tightening boundaries, not from external conquest, but from internal arithmetic. The challenge ahead isn't avoiding debt. Debt is permanent now. The challenge is managing its gravitational pull, recognizing that every dollar committed to past obligations is a dollar unavailable for future adaptation. This isn't pessimism, it's clarity. And clarity is the first condition of agency. When we see the structure clearly, not as crisis, not as conspiracy, but as architecture, we regain the ability to navigate within it, not with panic, not with denial, but with eyes open to both constraints and possibilities. In a world losing slack, flexibility becomes the ultimate currency, not just for nations, but for you. The ability to pivot when systems stiffen, to build resilience when buffers thin, to recognize that the greatest risk isn't debt itself, it's rigidity in the face of change. The structures around us may be transforming, but our capacity to adapt remains ours to claim. And in an era of quiet constraint, that capacity may be the last true form of freedom. So here's the question that remains. Is America's $38 trillion debt a ticking time bomb, or is it the new foundation beneath our feet? What do you think? Can America sustain this level of borrowing indefinitely? Drop your thoughts in the comments below.